All right. Good morning, everybody. Good morning, all you magnificent melon heads, and happy Friday, everybody. Today is April 12th, 2024. And a top story this morning, I'm not sure which one's top. Take your pick. It's either bank earnings or metals. Both very big stories. Let's start with bank earnings because it's the newest one, just hitting the tape a few hours ago. We're getting earnings in from big banks, JPMorgan, Wells Fargo, Citigroup, all reporting, and they're not terrible. Let me just start that. This is not dogs and cats living together in these bank earnings. Some of them, there were some good things in there. Some things were up, some things were down. But you guys know me. I don't really do optimism here. I tend to focus on the bad. I don't do it on purpose. It's just my nuclear training. I always look for what's going to go wrong in every situation. So what I'm seeing across all of these big bank earnings this morning is net interest income is getting squeezed. I'm seeing pressure on margins for the big banks. They're having to pay more for deposits, more money to convince people to stay at their bank or to draw people into their bank. And they're earning less money from making loans. Or in a lot of cases, they're having to shell out money to replenish the deposit insurance fund over at the FDIC. We saw a lot more of that. We're seeing some charge-offs for commercial real estate, notably at Wells Fargo. JPMorgan coincidentally released a little bit of the money they had set aside for loan losses. So it's weird. JPMorgan seeing a little bit less risk at their bank than a Wells Fargo is. But it's interesting to see compressions in net interest margin at the big banks. And why that jumps out at me is because the big banks really pigged out last year. While Silicon Valley and Signature and First Republic, with that whole regional crisis that we had last year in the small banks and the medium-sized banks, the big banks were getting bigger. The big banks were seeing people run to them for the, in my opinion, perceived safety of a large institution. I don't think they were any safer than the other banks. It's just JPMorgan is so big, the feds would be crazy to let them fail, right? So my money will be safe there. That was the prevailing logic in the banking industry last year. So the big banks didn't have to raise the rates they were paying on their deposit accounts. They didn't have to. The money was coming to them anyway. So they weren't really being competitive with the smaller banks. Well, this morning we're seeing a lot of compression in net interest margin. We're seeing the banks are having to pay up now. The big banks are finally having to pay up to keep the money there. And some of them are even mentioning deposits contracting. We've got deposits down at JPMorgan. And we've got total deposits down at Wells Fargo. That's new. We didn't see that last year. We saw deposits at small banks falling, and the deposits were running to the big banks. So the market is playing very defensive today. I'm speculating a little bit here, but I suspect what's going on is people are looking at, margins being compressed at the big banks. Maybe that's not a big problem in and of itself. But then what might happen next week at the small banks, the ones who already are having trouble, if their margins are getting compressed further also, well, a lot of them are already being squeezed out of business. So I think we've got some worries about regional banks because we see some things in the big banks that aren't great. They're not terrible. I just want to emphasize this isn't the sky is falling in the banks. There's no reason to be fearful of these big banks. None of them are failing or anything like that. But they are a little wobbly here. There are a couple of minor cracks showing here. And that makes me wonder, what are we going to get from a New York Community Bank? What are we going to get from a Western Alliance or a Valley National Bank? The banks that people are worried about that do have a lot of this exposure to commercial real estate. And I just keep thinking about that AT&T tower in St. Louis. And I was talking about this on Twitter yesterday. That AT&T tower that just sold for, what was it, $4 million yesterday after selling for $5.5, or was it $3.5 million? It sold for like $2.40 per square foot. This 1.5 million square foot office tower sells for less than $250 a square foot. And I'm pointing out on Twitter, guys, you can't even change your carpet at Home Depot for less than $250 a square foot. And that's what these 1 million square foot buildings are selling for. And a couple other people on FinTwit correctly pointed out, that's less money than a 3-bedroom ranch in freaking LA or San Francisco will cost you, because those markets are just out of control. There's such a mess in real estate right now. How could it possibly not show up in banks? How could losses be that big? I mean, that AT&T tower sold for less than 2% of its 2006 value. How could this not show up in banks? Now, I just want to mention that specific tower, the AT&T tower. Most of those losses were actually taken a few years ago. So that specific case is not going to stress any particular bank this quarter. But that's just an example. This is what's happening. This one rectangle and this one skyline of this one city of this one state, hundreds of millions in losses. Extrapolate that across the whole economy. People are kidding themselves if they think this isn't going to blow up banks. This is going to be absolutely massive. Seeing a little bit of that with the big banks, but it's mainly the little banks that are exposed to commercial real estate. That is the little banks and your pension, if you're lucky enough to have one, because most of that debt resides on the balance sheets of small banks, insurance companies, and retirement accounts. Also going on this morning, we've got, I don't want to say a flight to safety, but a casual stroll to safety is happening this morning. We've got interest rates are down in the bond market. People are buying bonds again for the safety, the perceived safety. I know somebody's going to make a comment about bonds not being safe. I'm in T-bills short term. I don't see any risk there. But there is when things get bad, people run to bonds and you see interest rates fall. We're seeing that this morning a little bit. We're also seeing gold and silver just running like crazy. I'd love to see it. Silver, $29. You know how long I've been waiting to see that? A long time. I've been waiting a long time to see silver at $29. I'd like to see a retest of that 28.30 level and then a sustained move higher. I'm not declaring the all clear, but I just love to see the shiny going up. Gold pushing $2,400 this morning. Say what? $2,400 gold. Look, guys, when you see gold and silver running in the face of higher rates, because interest rates have only risen at the beginning of the year, and gold and silver are saying, I don't care, I'm going higher because I have so little confidence in the financial authorities' ability to handle this mess, I'm just going to defy all traditional correlations, just buy gold and silver. And as Doomberg pointed out in an interview yesterday, this isn't something we should really celebrate. All right, now, look, metal stackers, you guys like metal. I like metal. And, if you've been piling into metal for the last few years, like a lot of us have, it's easy to get excited. But let's keep in mind what this means. All right. Gold running like crazy, silver running like crazy. These are not the harbingers of good times to come. These are not good omens. All right. These are not things to smile about. This generally happens when very bad things are about to happen. Case in point, the gold and silver rally of 2020 that we all saw. It was a nice big rally. We all loved it. That was forecasting the inflation that so many people suffered from over the following several years, not to mention the big drawdown in stocks in 2022. So what is gold forecasting here? And my gut tells me gold is forecasting trouble in the banks. And I had somebody ask me the other day, what would I do? Is there an inverse regional bank ETF or some way to go out and short regional banks? And I just couldn't help but thinking, and again, guys, not a financial advisor. There are better traders than me out there. So don't get your trade ideas from me. All right. This is just news and macro and my opinion here. I don't know that I would be that creative if it came to regional banks, that I would go out looking for an inverse ETF or some way to lever up. Look at what gold and silver did last March. Gold and silver did incredibly well during the regional bank crisis last year. So if you think that's coming again, why not keep it simple and just go to the safe haven asset that outperforms during times of upheaval? I don't know that we need to go into levered ETFs that over time just decay away and lose money. That's just my opinion. Also going on this morning, big decrease in Chinese exports, possibly another thing that's adding to this leisurely stroll to safety this morning. It's not quite a flight. It's just a leisurely stroll. But exports in China down 7.5% year over year. That China reopening thing. Remember zero COVID and everything was going to be great. Oh, China's reopen is going to rejuvenate the whole global economy. Nah, that never happened. Exports are down again. China is the world's factory, and when their exports are down, you better take notice. That is a global economic slowdown is what China's exports are telling you. Less cheaply made crap selling around the world. That includes the U.S. And with that, why don't we shrink my big melon of a head? Let's see what's going on in this market of ours this morning. And guys, don't forget the like button when we're changing our screen here. It really helps with the YouTube algorithm. And if you're new to the channel, please hit that subscribe button and the notification bell right next to it, because we do this every morning. So have your coffee with the melon heads as we go through the markets, which this morning, there's a lot of red in markets. Not deeply in the red, but red across the board. The S&P is down 45 points, about 0.87% lower. Not liking the bank earnings this morning. Again, the bank earnings weren't terrible, but I think people are saying the big banks are a little wobbly, then the little banks must be in big trouble here. The Dow is also down 301 points ahead of the opening bell, 0.78% lower. Not looking like a good day in stocks ahead of us here. And the NASDAQ leading the way lower, down a full 1%, 183 points lower to the NASDAQ. So we are definitely risk off in stocks. Now take a look at the dollar. Look at this thing running another 69 basis points today. We just recaptured 105 a few days ago, and we're already at 105.98. Congratulations to my cuz Brian, who is loving that stronger Dixie again. Guys, as far as a leisurely stroll to safety, now a lot of you may not share this belief, but around the world, when times get bad, where do you run? You run to the dollar. That's what a lot of other countries do. A lot of people who are if you're in Turkey, you have no choice but to run to the dollar because the lira is being inflated away to nothing. So when I see the Dixie rising, again, I'm thinking we got our leisurely stroll to safety going on this morning. And again, we're almost pushing 106. The dollar is running like crazy here. And that's another reason why this move in gold and silver is so impressive, because that's usually a headwind for precious metals. And yet the metals don't care. They're rallying anyway. Looking over at the bond market, we've got yields notably on the long end of the curve are sharply lower this morning. The 30-year Treasury down 6 basis points, 4.602. The 10-year Treasury, 4.499. That's down almost 8 basis points. The 2-year is down 8 points to 4.878, and the 1 month is at 5.386, up a fraction of 1 point. So when you see yields falling, remember the inverse correlation between interest rate and price. That means people are buying bonds this morning. Again, looking for a little bit of a safety trade here. And commodities, you got the same thing. Look at these beautiful numbers in precious metals. Again, I'm trying not to get too excited because I understand what this means, but you can't help but feel enthusiastic when you've been buying metals for years and you finally, we're seeing metals start to move. And this isn't even the unwinding of the shorts or the collapse of the price manipulation scheme. I think this is just the market anticipating higher inflation on the horizon. We've got June gold futures, $2,413, up $40.70 this morning, or 1.72% higher. Spot gold is a little bit lower, still below 2,400 at 23.96. But those June futures are looking great here. Metals just keep rallying no matter what happens in the market. Silver, same thing, $29.32 for May silver futures. That's up over $1 this morning, $1.07, 3.8% higher. Spot silver, $29.22. We broke above that all-important $28.30 level. We'll talk about that more in a second. Platinum and palladium getting in on the move this morning as well. We've got 2.4% higher for platinum, 3.7% higher for palladium. And crude oil, let's talk briefly about crude here. $87.04 for May WTI futures. That's up $2 this morning, 2.36%. The whole world, they've been saying this for a week or two now, but there is a lot of chatter in the OSINT community and Twitter, and a lot of stuff being released in the news, and all of these diplomatic cables going out and flight restrictions. Everybody is expecting the Iranians to attack the Israelis soon, as in, like, Mish and I were talking, he's going to send me a text if it happens while I'm live. I hope it doesn't happen. I hope reason and sense prevails and we stop just aimlessly killing each other for stupid reasons. But it looks like that's going to get worse before it gets better. Now, they've been saying this for a while. I don't know if this is it's wag the dog, the military-industrial complex, all that commentary. I'm just passing on the information. There's a lot of chatter that a large missile attack is imminent. The Iranians targeting Israel in retaliation for some hits on the consulates in Syria, and also everything going on in Gaza. That obviously would be incredibly bullish for oil prices if that happened, because if war broke out with Israel and Iran, there's a very good bet that would affect the flow of oil through the Strait of Hormuz, and you better believe oil prices would move up in a big way if anything like the Red Sea were to happen in the Strait of Hormuz. We'll be talking about $200 oil, not $87 oil, if something like that were to happen. All right, now let's look at some of these charts. Gold chart. This is spot gold. There we broke above that all-time high from a few weeks ago, and we just have not stopped moving ever since. 23.97 for spot gold here. Up and to the right. I like to see that. Look at silver also. That red line right there, that's that all-important $28.30 technical level that I highlighted on some of my earlier streams this week. That is where Mr. Slammy has historically showed up to take away all your hopes and dreams and issue paper and slam that price back down. But right now, Mr. Slammy is still asleep at the wheel. Silver is being allowed to run 29.27 spot price for metals here. Now, look, guys, the reason I keep pointing this out, you got 28.30 or so, and then, you got $30 as a psychological level above that. But let's zoom way out here. Like, let's set this to 1 week charts. If we break above this level, technically speaking, guys, where do we go from here? We're talking about playing catch up with gold somewhere near silver's all-time high. I mean, the gold to silver ratio is still very high. I believe it's still up in the high 80s, where historically, mid 60s is where you want to be. Gold is still running, so that's having a drag effect on silver too, and silver's got a lot of catch up. So if we break above, we hold above this, current level, even rise above 30, then we're going to be talking about high 40s real soon here, because there's just not a lot of resistance in the charts, not a whole lot of technical anything above this level to draw from. So again, I'm still holding back. I don't want to get too enthusiastic about it. But right now, I've been expecting Mr. Slammy for a couple of days, and he has not showed up yet. Bitcoin this morning, also $70,231. I'm sorry, $70,231. It's up about $200 here. Not a lot happening in the Bitcoin markets. Not a lot of talk about ETF flows or anything at the moment. But there are two stories to keep an eye on in the Bitcoin market. The first one is this story. Hong Kong is set to approve a Bitcoin and Ethereum ETF by Monday. I don't know if this is rumor mill or if this is legit or not, but I would just add that right now, gold, there's a big appetite for gold and silver in Asia, in Hong Kong, and China. And if we do get a Bitcoin and Ethereum ETF approved in that market, it stands to reason, based on Western behavior, how gold and silver tend to move at least directionally in the same direction, it stands to reason that we would see a lot of new money flowing into Bitcoin from that market if this were to happen. Because to my knowledge, and correct me if I'm wrong out there, Bitcoiners, there are no other Bitcoin ETFs approved in Hong Kong or China at the moment. And so approval here would result in a lot of money flowing into Bitcoin in that market. So we could see a second wind of the inflows into ETFs if that does get approved. And I just got to mention, we are now just 9 days, 18 hours, and 15 minutes as of the making of this stream away from the next Bitcoin halving. And just go look at the charts. Look at what happened during the prior 3 halvings, or should I say after the prior 3 halvings. The 18 months following a halving event in Bitcoin have historically been fireworks for Bitcoin prices. And we're starting this one at an all-time high. I think the numbers in Bitcoin are going to defy a lot of your beliefs over the next couple of months, guys. Now let's get into the banks, the big banks. Big one here. JPMorgan profit rises 6% in the first quarter, but Dimon warns of persistent inflationary pressures. Jamie Dimon using some strong language. Now, he's known to use some strong language. He had the, what did he call it? A hurricane was coming, he said last year. And of course, stocks went on to rally like crazy all last year. So I guess take that with a grain of salt. But listen to some of the things JPM is doing here. Profits for JPMorgan Chase rose 6% in the first quarter to $13.4 billion. That's beating Wall Street expectations, even as its boss offered some warnings about the road ahead for the U.S. economy. Many economic indicators continue to be favorable, the JPMorgan CEO said. However, looking ahead, we remain alert to a number of significant uncertain forces. He cited wars and geopolitical tensions, persistent inflationary pressures that may likely continue, and a campaign of quantitative tightening from the Federal Reserve, which I thought that QT was on the way out, right? Didn't they just talk about starting to slow that in the last FOMC meeting? We do not know how these factors will play out, but we must prepare the firm for a wide range of potential environments to ensure that we can consistently be there for clients. That's kind of a little bit of doomer talk from the CEO of the world's biggest bank here. I'm not going to lie. Now, some notable things. JP Morgan's net interest income in the first quarter was up 11% from a year ago. Now, keep in mind, net interest income should be up a big amount from a year ago because JP Morgan ballooned in size when they bought up First Republic Bank. So a lot of that was just the bank is bigger now, not necessarily the business getting better. But their net interest income dropped 4% from the previous quarter sequentially. Now that's big, right? Because if you take away the effect of First Republic that's shown in the year-over-year numbers, you actually get a 4% drop in the quarterly net interest income. That's a bad sign for JPM, and it's a much worse sign for the other banks. And that 4% quarter-over-quarter drop in net interest income, that was driven by deposit margin compression and lower deposit balances. And I think that's probably the most alarming thing I read this morning, to see that from JPMorgan. Deposit margin compression means we're having to pay out what we give people in interest on their savings and their checkings and their money markets, and we're not being able to offset that by charging more for our loans. So their margins are being compressed, and at the same time, their deposit balances are lower. Deposits leaving JPMorgan. We didn't see that last year during the banking crisis. We saw deposits running into JPM like crazy last year. So to see deposit balances lower at JPMorgan, keep an eye on that one. That may not be a very good omen for the smaller banks. JPMorgan stock this morning actually faring pretty well, all things considered. Trading down. Well, I'm sorry, market's not open yet. Down 3%. JPMorgan stock is under pressure this morning. 189.50 for JPM. That's down almost $6. And we got some similar things from Wells Fargo also. Wells Fargo sees net interest income drop as pressure from depositors mounts. There's that same theme. Interest margins getting squeezed at the big banks. They didn't have this problem last year when all the small banks were dying. This is not a good sign. Wells Fargo and Co. missed estimates for net interest income in the first quarter, a sign that muted loan growth and increased pressure to pay out more for deposits are eating into the benefit of higher rates. The firm earned $12.2 billion in net interest income in the first 3 months of the year, according to a statement on Friday. That is down 8% from a year earlier and slightly less than $12.3 billion that analysts were expecting. Still, overall revenue topped estimates, aided by an increase in investment advisory fees and brokerage commissions. So I guess the stock market bubble is helping their numbers a little bit here. Now, here's some more important details. The San Francisco-based bank reported a $1.1 billion in net charge-offs, i.e. people not paying back loan losses. That includes $187 million tied to commercial real estate. We haven't seen a lot of the big banks warning about commercial real estate. So here we go. Wells Fargo taking almost a $200 million hit. Again, that's not even the money that was lost on that one building out in St. Louis, but still it's showing up in the big bank earnings here. CFO Mike Santamassimo said in February that the firm's commercial property portfolio looks pretty good in most cases, put an asterisk there, but warned that issues in the space will take time to play out. In other words, we're not in a bottom. Pay attention, Blackstone, who desperately wants a bottom in commercial real estate. Expenses, a key component of Sharf's planned turnaround of the lender, came in at $14.3 billion. That's worse than analysts expected, and that included $284 million charge for additional FDIC special assessment stemming from last year's regional bank failures. So the big banks are still paying up for all the assets they bought on the cheap last year. They're still writing big checks to the FDIC to try to replenish the deposit insurance fund. We saw that at JPM. We're seeing that in Wells Fargo. Also, Wells Fargo stock doing a little bit better than JPM's this morning, down 0.95% ahead of the open, trading at 56.15. And let's also look at Citigroup. Some similar things here, although no real mention about net interest margin with Citigroup like we saw at JPM and Wells Fargo, but still some not quite so good things in here. Citi profit drops as costs rise for employee severance and deposit insurance. Just want to remind you guys, Citigroup has been involved in what they call Project Bora Bora. In other words, firing a whole bunch of people. And so they're seeing a big rise in the severance costs as they cut their headcount. That's starting to hit their earnings here. Citigroup profit fell in the first quarter as it spent more on severance payments for laid off employees and set aside money to refill a government deposit insurance fund. There's that FDIC charge again. Net interest income fell to $3.4 billion or $1.58 a share in the 3 months ended March 31st. The bank said on Friday that compares with $4.6 billion or $2.19 a share a year earlier. So a big drop in Citi's earnings here. Now, the one thing I'll also mention is the bank paid a $251 million charge into the FDIC deposit insurance fund. that was drained last year after the 3 regional lenders failed. So there's another instance of that money being paid to the FDIC. Citigroup stock doing all right this morning, up 58 cents or almost 1% higher at 61.29. We also got earnings from BlackRock and big milestone. BlackRock, $10.5 trillion of your money in assets under management. And go figure, their profit jumps because they collect fees on those assets under management and they just keep getting bigger. Talk about a market risk. This one firm gets everybody's money, $10 trillion of it. I'm sure that's going to end very well. BlackRock reported record assets under management of about 10.5 trillion with a T in the first quarter and posted a 36% jump in profit on Friday as a rebound in global equity markets boosted its investment advisory and administration fees. Global equity markets rallied in the first quarter as expectations grew that the world's major central banks were done with monetary policy tightening and would pivot to rate cuts, resulting in a jump in AUM. How's that working out for you guys? Everybody gave your money over to BlackRock. Go ahead and invest it in risky assets because the pivot is coming any day now. Oh, whoops, the whole inflation thing, we're not done with that. Maybe that was a bit premature. However, total net inflows fell to $57 billion from $110 billion a year earlier. Inflows continue to be soft as clients sit on the sidelines waiting for interest rate cuts to begin dipping back into risky assets. And I couldn't help but laugh at this statement that they're saying people are sitting on the sidelines waiting to dip back into risky assets. Have you seen super micro stock? Have you seen Nvidia? Have you seen Bitcoin? What do you mean clients are waiting to dip back into risk? If this isn't a drunkenly risky market, I don't know what is. If you're sitting on the sidelines waiting to take risk, well, first of all, I think there probably are some people sitting on the sidelines waiting to take risk. Not nearly as many as there should be, because I go on Twitter, I see a lot of people with IQs that are probably in the mid 80s who are bragging about how much money they're making in AI stocks, even though these guys probably couldn't spell AI if their life depended on them. And they're saying, oh, yeah, these people are waiting to dip back into risky assets as they bid up companies to 40 times sales. Okay. All right. If you say so, Reuters. BlackRock stock, though, is up about 0.25% this morning, $787.90, up about $1.94. And the last big story today, China exports year over year, another big slowdown in global trade showing in the numbers here. Keep in mind, Chinese government data, guys. So if they're going to report this, then it's a good bet it's a lot worse. Exports from China dropped 7.5% year on year to $279.6 billion US in March of 2024. That's reversing sharply from a 5.6% growth in the earlier month and worse than markets had forecast of a 3% drop, highlighting an uneven recovery in the country. You see, when things are getting worse and when everybody's poor and everybody's broke, they refer to that as an uneven recovery. I'd hate to see what a not recovery looks like, or an uneven recovery. That's mildly put here. That dashes hopes that the global demand would continue to help drive growth in the world's second largest economy. The decline in exports also came with a higher base effect in March of last year. We did have a big growth number in March of last year because that was right after the zero COVID nonsense. So they opened everything up. So we did have a big March number from last year drop off that did contribute to the downward move, but it doesn't explain it in its entirety. 7.5% is a big decline in exports from China. Let's see. For the first 3 months of the year, exports grew by 1.5% year over year to $807.5 billion. But again, what are we saying here? For the first 3 months, for the first 3 months, that's for the quarter, they're still up 1.5% year over year. But for the month, they're down 7.5%. And you can kind of see that in the chart. Again, this is the year over year change for that particular month. It looked like things were doing all right in China at the beginning of the year. We had some growth. We dipped a little bit in February and now slam, big drop down for the March numbers. And I just want to say thank you ever so much to M&J. Thank you for gifting 10 Nobody Special Finance memberships. I appreciate that, M&J, and I appreciate all you other channel members, you melonheads and magnanimous melonheads out there. Thank you very much for that. And if you guys received a membership, be sure and drop a comment to M&J in the comments and say thank you for that. Thanks, M&J. Appreciate the support of the channel. And what's going on, Mr. JJ Watt, who says, thanks for bringing us the truth every morning. You are most welcome, Mr. Watt. I appreciate that very much, sir. You are very welcome, and thank you for the kind words and the super chat. I appreciate that very much. And Mr. Ziebelfritz, thank you, sir. He says, just found out I can spend Google Play money here. Google Play money. All right. God, I need to get a business model where I invent my own currency. What a great business model that is. We got to take Meloncoin global. I'm going to do an ICO for Meloncoin. You know what I'm going to do? I'm going to pay a whole bunch of influencers to pump up Meloncoin. It's going to be the next big thing. I don't know. Maybe I'll get one of the Paul brothers or one of those other idiots on Instagram or something like that. I'm going to get them to pump it up. I'm going to issue 1 billion of them. 990 million will come to me. The other 10 million or so, I'll give a little bit to the influencers who are going to pump it. And then I'll put a ridiculously small float up for sale on the exchanges, get the influencers to gin up demand, and then I will rug pull and dump it all on the market and make a ton of money, rinse, repeat with 5, 6, 7 other different names and just make a fortune. That is how you make money in the altcoin business. And apparently it's very easy, and they just do it over and over again. And every time people show up to buy it. And I don't know how I got there from Google Play money, to be honest with you, Ziebelfritz, but thank you anyway. I really appreciate the super chat, sir, and the support of the channel. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you to all my members and magnanimous Melonheads and my Patreon supporters. I got links down below to all that good stuff, should you feel so inclined. I'll be back at 3:15 p.m. Eastern Time for my weekly wrap-up live stream. Hi, Mom. Hi, Dad. Love you guys. Till next time, live small and dream big.